Dave checks his bank account. Same balance as yesterday, same balance as last week, but he didn't work a single hour to get it. He's sitting in his truck outside a warehouse in Columbus, Ohio, engine still running, coffee going cold in the cup holder. 41 years old, still driving deliveries. And yet, for the first time in his life, money just showed up. Not from his boss, not from a side hustle, from companies he's never even set foot in, paying him just for owning a tiny piece of them. He didn't win the lottery. He didn't get an inheritance. He did something so boring, so unglamorous that almost nobody talks about it at parties. He bought dividend stocks slowly for 11 years and never touched them. And now those stocks are quietly handing him a paycheck whether he shows up to work or not. Here's the part that stops people cold. To live entirely off dividends, on an income most families would call comfortable, you don't need to be rich in the way you think. You need a specific number, a real calculable number. And once you hear it, you can't stop doing the math on your own life. That number isn't hiding in some secret vault only hedge fund managers get to see. It sits right there in the math, waiting for anyone patient enough to actually run it. Most people never run it because they assume the answer is so far out of reach that even asking the question feels embarrassing. Dave asked it anyway, sitting in a diner booth with a napkin and a pen that barely worked, and that one afternoon quietly rewired the next decade of his life. And if you've ever wanted to know exactly how many zeros stand between you and never needing a paycheck again, subscribe. Because we're about to do the math your financial advisor is way too polite to just say out loud. Dave wasn't always the type of guy who read financial statements. In 2013, he was 29, single, and renting a one-bedroom apartment above a laundromat, making about $38,000 a year hauling freight for a regional trucking company. He had $600 in savings and a credit card he was scared to check. His dad had worked at a factory for 32 years, retired with a pension that got quietly cut in half, and died 4 years later, still worried about money. That scared Dave more than any bill ever could. He didn't want a pension he had to trust. He wanted something he could see, something with his name on it. A coworker mentioned an app where you could buy a single share of a company for less than the price of a pizza. Dave laughed at first. Then he opened the app anyway and put in $50. That $50 bought a sliver of a company that paid him money 4 times a year just for holding on. It wasn't much. It was $2.11, but it was real, and it hit his account without him lifting a finger, and something about that flipped a switch in his head that never flipped back. He started reading everything he could find on his phone during breaks between deliveries, standing in loading docks with a sandwich in one hand and his screen in the other. He didn't understand half of what he read at first. Words like yield, payout ratio, and ex-dividend date meant nothing to him. But he kept reading anyway, because for the first time, money felt like something he could actually study instead of something that just happened to him. His girlfriend at the time thought it was a phase, the way some guys get obsessed with fantasy football stats for a summer and then forget about it by fall. She wasn't wrong to be skeptical. Dave had tried and abandoned plenty of things before: a home gym setup, a side business flipping sneakers, a diet plan that lasted 11 days. But this one felt different because every quarter, without fail, a little more money showed up whether he thought about it or not. The first number nobody tells you. Most people think living off dividends means being a millionaire 10 times over, the kind of wealth reserved for yacht owners and hedge fund managers. That's not exactly true, and it's not exactly false either. The real answer depends on one brutally simple formula that almost nobody explains clearly. If you want a dividend portfolio paying you an average yield of 4% a year, and you want that to generate $50,000 annually, you need $1.25 million invested. Not saved in cash, invested, working, spread across companies that actually pay you to hold their stock. Want $80,000 a year instead? Now you're looking at $2 million sitting in dividend-paying assets. Want just $30,000, enough to cover a modest life in a low-cost city? That drops to $750,000. The number moves with your lifestyle, not the other way around. And that single sentence is the part most people never sit with long enough to understand. Dave did the math on a napkin at a truck stop outside Toledo in 2015. He wanted $45,000 a year, enough to match his current job's income without ever showing up again. At a 4% yield, that meant he needed $1.125 million. He remembers laughing out loud in an empty diner because the number felt like a joke someone was playing on him. But then he did something most people never do. He stopped looking at the whole mountain and started looking at the next step in front of him. The math that changes everything. Here's where the story stops being about Dave for a second, because the math underneath his choices is the same math underneath every single person who's ever pulled this off. A 4% yield is not a random guess. It comes from blending safer dividend payers, the kind that raise their payouts every single year, with a few higher yield names that carry more risk but pay more upfront. Utility companies, consumer staples, big pharmaceutical names, real estate investment trusts, which by law have to pay out 90% of their taxable income to shareholders every year. Blend those together and you land somewhere between 3 and 5% annually, depending on how aggressive or conservative you want to play it. Push the yield higher, say to 6 or 7%, and the required portfolio shrinks fast. Suddenly, that $50,000 goal only needs around $800,000 instead of $1.25 million. Sounds incredible, right? Except higher yield almost always means higher risk. Companies stretching to pay dividends they can't actually afford, and portfolios that can collapse the moment the market gets nervous. There's a simple warning sign experienced dividend investors watch for called the payout ratio, which measures how much of a company's profit is actually going out the door as dividends. A company paying out 40 or 50% of its earnings has plenty of room to keep those payments coming, even during a rough year. A company paying out 95% or more is running close to the edge, and a single bad quarter can force it to cut the dividend overnight, taking the stock price down with it. Dave now checks that single number before buying anything, a habit that took him years and one painful loss to build. It's not glamorous. It's not the kind of thing that gets clicks on financial forums promising overnight riches. But it's the difference between a dividend that actually shows up every quarter for the next 30 years and one that vanishes the moment things get difficult. Dave learned this the hard way in 2016 when he chased a stock paying an eye-watering 9% yield, poured in $4,000 he'd saved over a year, and watched the company slash its dividend to nearly nothing 5 months later. The stock price fell with it. He lost almost half of what he put in, and for 2 weeks he didn't open the app at all. He remembers the exact moment he saw the announcement, standing in a gas station parking lot at 6 in the morning, phone screen glaring in the early light. The company had blamed rising debt and a slowing industry, words that meant nothing to him at the time, but that he now recognizes instantly on any earnings report. It was the kind of mistake that costs money but teaches a lesson cash alone never could. What made it worse was watching other investors online act like they'd seen it coming all along, posting screenshots after the fact claiming they'd sold weeks earlier. Dave stopped listening to strangers online after that and started reading actual company earnings reports instead, boring as they were, because at least those numbers didn't lie to make themselves look smart. That single mistake taught him something that no napkin math ever could have. The number isn't just about how much you need. It's about how stable that number actually is when the market stops being kind. The number changes with your zip code. Here's a piece nobody puts in the headline because it ruins the clean simplicity of a single magic number. The amount you actually need depends entirely on where you plan to live, and the difference is enormous. Someone aiming to live off dividends in San Francisco or New York needs a completely different portfolio than someone planning to settle in a small town in Ohio or Alabama. Dave ran the numbers for 3 different versions of his future self one night, unable to sleep, laptop balanced on his knees at 2 in the morning. Living in an expensive coastal city, he calculated he'd need close to $70,000 a year just to cover rent, food, and basic bills, which at a 4% yield meant a portfolio of $1.75 million. Staying in a mid-sized Midwest city dropped that number to $45,000 a year, requiring $1.125 million. But the version that actually stopped him cold was the smallest one, a quiet, rural town 2 hours outside Columbus, where he could buy a modest 3-bedroom house outright for under $150,000. There, $30,000 a year covered everything comfortably, which meant the number dropped all the way down to $750,000 invested. Same dividend strategy, same companies, same 4% yield. The only thing that changed was his zip code, and suddenly the goal felt half as far away. That single realization changed his entire plan. He stopped comparing his number to strangers online bragging about seven-figure portfolios in expensive cities and started building toward the number that actually matched the life he wanted to live. It was the first time the goal felt personal instead of borrowed from someone else's highlight reel, and that shift alone kept him motivated through years that otherwise felt impossibly slow. The portfolio nobody expects. By 2018, Dave had changed his entire approach, and it looked almost boringly simple. He built what people in finance circles call a dividend growth portfolio, companies that don't necessarily pay the highest yield today, but that have raised their payments every single year for decades, sometimes 50 years straight without missing once. He put money into names most people recognize instantly, companies that make toothpaste, diapers, soft drinks, and prescription medicine. Not exciting, not the kind of stock you brag about at a barbecue. But these were companies that kept paying shareholders through recessions, through pandemics, through wars, through every kind of chaos the last half-century could throw at them. He automated it. Every single paycheck, $300, moved straight into his brokerage account before he could even think about spending it. He set every dividend to reinvest automatically, meaning the $2.11 from that very first purchase kept buying tiny slivers of more stock, which then paid him more dividends, which bought even more stock. By 2020, during a global pandemic that crushed nearly every industry on Earth, Dave's portfolio didn't just survive. It kept paying him. Rent came due, groceries got more expensive. And every quarter, without him doing anything at all, more money landed in his account than the quarter before. A few of his holdings did freeze their dividend growth that year, and one smaller company paused its payout entirely for 2 quarters before restoring it. Dave didn't panic because he'd built the portfolio wide enough that no single company losing its footing could sink the whole thing. Watching the total still climb, even while individual pieces wobbled, taught him more about diversification than any article ever had. That's the moment he stopped thinking of this as an experiment and started thinking of it as an exit plan. The tax bill nobody warns you about. Somewhere around 2019, Dave got a letter in the mail that made his stomach drop, a tax form showing he owed money on dividends he'd never actually spent. This is the part nobody mentions at parties, and it's the part that quietly wrecks a lot of people's math if they don't plan for it early. Not all dividends get taxed the same way. Qualified dividends, the kind paid by most stable, long-running companies, get taxed at the same lower rate as long-term capital gains, sometimes as low as 0%, depending on total income. Ordinary dividends, often paid by real estate investment trusts and some higher yield funds, get taxed like regular income, which can mean a much bigger bite depending on the bracket. Dave learned to keep his higher yield, higher tax investments inside a retirement account shielded from yearly taxes, and his stable, qualified dividend payers in a regular taxable brokerage account where the lower rate applied. It sounds like a small detail. It saved him almost $1,100 in his very first year of doing it correctly, money that went straight back into buying more shares instead of disappearing into a tax bill. This single shift meant the real number he needed wasn't quite the same as the textbook number. Because of smarter tax placement, his actual required portfolio ended up almost 8% smaller than the raw math would have suggested, simply because less of every dollar he earned got skimmed off the top before it ever reached his pocket. The waiting game. Nobody wants to hear this part because it's the least exciting piece of the entire story, but it's also the piece that separates the people who actually reach the number from the people who just talk about it at parties. Time is the real engine here, not luck, not timing the market, not finding some secret stock nobody else knows about. Compounding is slow at the start, almost insultingly slow. In year 1, Dave's reinvested dividends added maybe $40 extra to his account. In year 3, it was closer to 200. It felt like nothing was happening, like he was pouring water into a bucket with a hole in the bottom. Then somewhere around year 7, the bucket started filling faster than the hole could drain it. By 2022, 9 years after that first $50 purchase, Dave's portfolio had crossed $400,000. His annual dividend income alone, without adding a single new dollar, had reached just over $14,000 a year. Not enough to quit yet, but enough to notice, enough to feel the shift in the air, enough to keep going even when it was tempting to spend that extra cash on something else. He kept his old apartment above the laundromat 2 years longer than he needed to. He kept driving the same truck route. From the outside, nothing about his life looked different. But underneath, every single quarter, the machine was quietly getting bigger. And the number that once felt like a cruel joke was slowly turning into something that felt almost inevitable. By early 2024, at 40 years old, Dave crossed $1.1 million in dividend-paying assets. The truck stop napkin math from 9 years earlier had finally caught up to his real bank account, almost dollar for dollar. Along the way, there were setbacks that had nothing to do with the market at all. A transmission on his truck blew out in 2019 and cost him $3,000 he'd planned to invest that quarter. A short stretch of unemployment in 2021, when his trucking company downsized, forced him to pause new contributions for 5 months. He didn't sell anything during that stretch, but he also didn't add a single dollar, and the portfolio simply sat there, quietly reinvesting whatever dividends it already produced. Looking back, Dave says those pauses taught him almost as much as the good years did. The machine he'd built didn't need him to feed it perfectly every single month. It just needed him to never rip it apart during the hard stretches, to let compounding keep working in the background even when his own life outside the portfolio felt shaky and uncertain. The life on the other side. The morning Dave decided to actually quit, nothing dramatic happened. There was no confetti, no boss to dramatically walk out on, no big speech. He simply looked at his dividend income for the trailing 12 months, saw it had crossed $47,000, and realized it now matched what his job paid him after taxes and expenses. He gave 2 weeks' notice on a random Tuesday. His manager asked if he'd gotten a better job somewhere else. Dave said no, not exactly, and left it at that because trying to explain dividend investing to someone at 7 in the morning felt like more effort than it was worth. Life on the other side isn't glamorous, and Dave is the first person to say that out loud. He still checks prices at the grocery store. He still drives the same 8-year-old truck. But every quarter, money arrives from over 40 different companies, spread across industries that have nothing to do with each other, none of them requiring him to show up, clock in, or answer to anyone. The strange part isn't the money itself, it's the quiet. No alarm clock tied to someone else's schedule. No fear of a single company laying him off and erasing his entire income overnight. His paycheck now comes from dozens of sources instead of one, and that spread is worth more to him than any single number in a spreadsheet. He spends his mornings now the way he used to spend Sunday afternoons, slow, unhurried, without a clock somewhere in the back of his mind counting down to a shift. He still does small jobs sometimes, helping a neighbor fix a fence, driving a friend's kid to soccer practice, but nothing tied to a paycheck, nothing he has to show up for. The difference between working because he wants to and working because he has to turned out to be the entire point of the last 11 years. His old coworkers still ask him about it sometimes, half joking, half genuinely curious, wondering if he's secretly miserable now that the structure of a job is gone. He tells them the truth, which is that the first few months felt strange, almost too quiet, like a sound had been turned off that he didn't realize was always playing. But that feeling faded, replaced by something closer to normal, a life where money simply exists in the background instead of dictating every single decision he makes. A couple of them have started asking real questions now, not jokes anymore, wanting to know where to even start. Dave tells them the same thing every time, that the number matters less than the first $50 and that nobody ever feels ready before they begin, not even him, back in that diner all those years ago. The twist nobody talks about. Here's the part that actually matters more than the dollar figure. The real skill was never picking the perfect stock or finding some secret formula. It was Dave's willingness to feel poor for years, while his account balance barely moved, and keep going anyway. Most people quit at year 2, when the numbers still look like a rounding error. The people who actually reach financial independence through dividends aren't smarter than everyone else, and they usually aren't luckier either. They're just the ones who kept feeding the machine long after it stopped feeling exciting, long after friends stopped asking about it, long after it would have been easier to just spend the money. Wealth built this way isn't a story about money at all. It's a story about boredom, patience, and refusing to stop during the years when absolutely nothing seems to be happening. Think about how differently our culture treats this compared to almost every other version of getting rich. Nobody makes a movie about a guy who quietly reinvested $300 a month for 11 years. It doesn't have the drama of a startup exit or the thrill of a lucky trade. But it's the version that actually works for almost anyone willing to sit through the boring middle part, and that's precisely why so few people ever finish it. There's also something quietly rebellious about it, even if Dave never framed it that way himself. Every dollar he put into those companies was a small vote against needing anyone's permission to survive. No boss could take away a paycheck that didn't come from a boss in the first place. No single layoff could erase an income spread across 40 different businesses in a dozen different industries. Dave still thinks about that napkin math from the truck stop sometimes. $1.125 million looked like a fantasy number back then, something other people reached, not truck drivers from Columbus. It took him 11 years to prove himself wrong, and he did it $3.50 at a time. He still has that napkin, actually, folded up in an old shoebox with a few other things he never bothered to throw away. The ink has faded, and the handwriting looks rougher than he remembers it being. But the number on it, the one he thought was a joke, matches almost exactly what shows up in his brokerage account today, down to the last few $1,000s. He's not rich in the way movies show rich people. He doesn't own a yacht, and he still buys groceries on sale. But he owns something most people never build for themselves, a paycheck that doesn't care whether he shows up, whether he's sick, or whether he ever works another single day in his life. If there's one thing Dave wants people to take from his story, it's that the number was never really the hard part. Anyone can look up a yield calculator and figure out what they'd need. The hard part was showing up quarter after quarter, year after year, watching a bucket fill so slowly it barely looked like it was filling at all, and choosing to keep pouring anyway. Most people who fail at this don't fail because the math is too hard. They fail because year 4 looks almost identical to year 1, and it's tempting to assume nothing is working when really everything is working exactly on schedule, just far too slowly for anyone to notice day to day. If you want more stories about ordinary people quietly buying their way out of the paycheck-to-paycheck grind, subscribe, because apparently the secret to freedom isn't a lottery ticket, it's a spreadsheet, some patience, and 11 very boring years.